Hello and welcome to Accounting with Mr. H. In this video we're going to look at incomplete records and how to prepare an income statement from incomplete records. Please do subscribe to the channel, thank you so much if you already have. Like, share, comment on the videos, let me know what you find useful and what you'd like to see in future videos. Okay, before we get into the question, I think it's worth just taking a moment to talk about incomplete records. So incomplete records are situations where a business does not have all of the details, all of the figures, facts, information that you need to go ahead and prepare an income statement or a statement of financial position. The most common reason for incomplete records is that the owner of the business it's perhaps a sole trader business, and they're perhaps just too busy running the business to keep detailed records, or perhaps they don't have the skills to keep detailed records. So they'll have some information, but they don't have all the exact records, all the double entry bookkeeping that you would have perhaps in a more established business or a larger business, a limited company, for example, who might have their own accounts department. So when it comes to incomplete records, we need to have some techniques to find missing figures, and you can see these on the screen. So this topic kind of links in with lots of other topics because we will need to use things that you've learned elsewhere to help find missing figures. So the examples we got then: control accounts, which you might also know as total accounts. It's the same thing. So a sales ledger control account, a purchase ledger control account can help us to find a missing figure. We might look at cash and bank accounts and just produce a simple cash account or bank account to help find missing figures. Ratios, so particularly ratios such as gross profit margin, markup, profit in relation to revenue, rate of inventory turnover. These ratios in particular can be helpful in finding missing figures. Being able to calculate depreciation and being able to calculate a profit or a loss on disposal. And finally, we can actually use the financial statements themselves to help us find missing figures. So, for example, we could use an income statement and we could put in what we do know and sort of work backwards to try and find out where we've got missing figures. So in the question that we're going to look at in this video, I have included one aspect of all of the things there shown in green. So we're going to have an opportunity to look at all of the techniques all in one question, and hopefully that will help you a little bit to understand the topic. Right then, here we go then. So the question then's on the left-hand side. Bruno does not keep full records for his small business. So what information have they given me? They've given me some of his assets and liabilities, and I can see I've got some balances at the 1st of May 2023 and some balances at the 30th of April 2024. I can see there's a couple of question marks. For example, the equipment at net book value at the end of the year, Bruno hasn't been able to provide that figure. Neither has he been able to provide his closing inventory. I've got a bank account summary for the year ended 30th of April 2024, and I can see there they've called it a summary. In other words, it's just totals. So, for example, on the debit, you can see trade receivables 70,830. That's the total that he has received through the bank from his trade receivables across the whole year, during the whole year. Additional information underneath: 80% of his sales were on credit. The remainder were cash sales. All goods are sold to achieve a 50% gross profit margin. The rate of inventory turnover was 73 days. Bruno banked all cash sales after deducting cash drawings of £3,000. The equipment sold originally cost £6,500 and had been depreciated by £4,500. Depreciation on equipment is charged at 20% using the reducing balance method. A full year's depreciation is charged in the year of acquisition. No depreciation is charged in the year of disposal. Bruno believes some cash has been stolen, and I'm being asked then to prepare an income statement for the year ended 30th of April 2024. You'll see I've already put my title and drawn out my columns, so I'm all set to go. So let's get stuck in then to working this out. So any income statement will always start with revenue. So there we go, let's get that written in, revenue. But I don't remember reading any of the question that it just told me the revenue figure. What I do remember is the first bullet point says 80% of his sales were on credit, the remainder were cash sales. So I've got to start unpicking and thinking, okay, well, where can I go from here? How can I possibly work this out? Well, I haven't been given a cash account. So although they've told me the remainder were cash sales, that's not really going to help me yet because I don't have a cash account. So I've got to look at the other part then. 80% of his sales were on credit. And if they're on credit, that means he's got trade receivables. And I'm looking at the question and I can see quite a lot of information about his trade receivables. So thinking about the techniques that we spoke about a moment ago, I'm going to use then a control account to help me work out his sales figure, or at least his credit sales figure. So let's get a working box. There we go. So working number one, there we go. As I say, I'm going to prepare a sales ledger control account. If I look at the table at the top, he knows that his trade receivables on the 1st of May, the beginning of the year, were 32,490. Trade receivables are an asset. He was owed that money at the start, so that's going to be the balance brought down on the debit of the sales ledger control account. So what was going on at the start of the year? There we go, 32490 was owed to Bruno. What happened during the year? Well, if I look in his bank account, I can see on the debit he received £70,830 from his trade receivables. So that then is going to be on the credit of his sales ledger control account because it's reducing the amount that his receivables owe him. And then lastly, what was going on at the end of the year? Well, the table at the top, I can see that Bruno knows he was owed £29,836 from his receivables at the end of the year. So that would be a balance brought down on the debit for next year, which means it will be carried down on the credit this year. And there it is. So now I can total up then the credit side. I get £100,666, take away that opening balance, and that gives me then my first missing figure. So we now know his credit sales must have been £68,176. I've just got to think back though to bullet point one. 80% of his sales were on credit. So that 68,176 is just the credit sales. But in the income statement, I want all of the sales, the credit and the cash. So the remainder, the other 20% must have been cash sales. So I just need to do another quick working to get this figure. And you can see my working there. So £68,176 is 80% of the total sales. So divide by 80 times 100, or just divide by 0.8 if you like working decimally. And that tells me then his total sales this year must have been £85,220. So I'm going to put that in the income statement as the revenue. There we go. I'm going to continue then with his income statement. So there's no mention of any returns. Quite often in these sorts of questions, we don't tend to find returns. So I'm just going to go straight into the cost of sales section. And another one of the techniques you'll remember from the start of the video is you can actually use the financial statements themselves to help you find missing figures. And what that basically means is just start laying it out as you know, and putting in anything that we do know. So cost of sales, I'm looking at the inventory at the start of the year. Does he know his inventory? Yes, he does. On the table on the left, inventory at the 1st of May, 8379. Well, I can put that in then. Purchases. Does he know his purchases? No, I don't remember reading purchases anywhere, but you'll see I've put the narrative, and I'm just going to leave that for a second then. No mention of any carriage or goods taken for own use. Closing inventory. So inventory at the 30th of April. Does he know that? No, that's where one of the question marks is. And that would give me the cost of sales, which would then help me work out the gross profit. So you'll see I'm using the income statement to help work out missing figures simply by putting all of the narratives and putting in any figures I do know. In this case, I only know the opening inventory. Then I'm going to step back and I'm going to think, right, where can I go from here? there's got to be a way of either working out the purchases, the closing inventory, the cost of sales, or the gross profit. So it's a case of looking through the information. Purchases, maybe I could do a purchases ledger control account. But to do that, I would need information about the trade payables, and it doesn't tell me any information about the trade payables. It doesn't say there are any cash purchases. So purchases I can't work out at the moment. Closing inventory. What do I know about closing inventory? Well, not a lot. It tells me in the third bullet point the rate of inventory turnover was 73 days. But I can't do much with that at the moment. So I come round to then the gross profit. And the second bullet point tells me that all goods are sold to achieve a 50% gross profit. So I can actually work out his gross profit. So my second working then is just simply, if he's selling his goods to achieve a 50% gross profit margin, that means that 50% of his revenue becomes his gross profit. So we know the revenue is 85,220, so 50% is 42,610. So that is his gross profit. And if half of his revenue is gross profit, the other half must be spent on the cost of sales. So now I can put the cost of sales figure in as well. So suddenly it's taking shape. I'm getting all these missing figures. So now all I've got left is the purchases and the closing inventory. Well, we've already said there's literally nothing to go on with for the purchases in this question. So I'm going to come back to this closing inventory and the fact that they've told us the rate of inventory turnover was 73 days. So here's another technique we spoke about, using ratios to help us. So I'm going to work out then the closing inventory. And the way I'm going to do this is using this ratio that they've given me of 73 days. So the formula for rate of inventory turnover, remember this can be calculated as a number of times or in days, but here they've given it to us in days. So the formula is the average inventory divided by the cost of sales multiplied by 365. And I can substitute then some of these figures. So we don't know the average inventory, but we do now know his cost of sales was 42,610. So I've got X on the top, because I don't know the average inventory, divided by the cost of sales, which is 42,610, multiplied by 365 equals, we're told, 73 days. So if I rearrange that formula then, in other words, work backwards from it, I'm going to do 73 days divided by 365 multiplied by 42,610. And that gives me 8,522. So that 8,522 is his average inventory. How would he have worked out average inventory? Well, we take the opening and the closing divided by 2. So the opening we know was 8,379. Add the closing, which we don't know, that's the figure we're trying to find out, divided by 2 equals 8,522. So again, I can work backwards. So 8,522 multiplied by 2, take away the opening inventory of 8,379, means his closing inventory must be £8,665. And now I can put that into my income statement. There we go. And so now all I'm left with in this question is the purchases. And again, this is this technique of using the financial statements themselves to help find missing figures. Because now that I know the opening inventory and the closing inventory and the cost of sales, I can work backwards to see what the purchases were. So if I take the cost of sales, 42,610, add the closing inventory, because I'm working backwards, so add 8,665, and then take away the 8,379, the opening inventory, that reveals that his purchases must have been £42,896. And there is the first part of the income statement complete. We've done the trading section. So I'm going to move on to the next slide to look at the other section. So we're at gross profit 42,610 so far. All right then, so on to the profit and loss section. It's obviously still all one income statement. I've just had to scroll mine up a bit because, so that I can get it all onto one screen. So gross profit 42,610, And now I'm thinking, is there any other income? Well, I don't remember reading anything about rent received or discount received, but I do remember that it gave me a hint that he had sold some equipment. And if I look back, yeah, the fifth bullet point, it says the equipment sold. So if he has disposed of a non-current asset, that has probably led to either a profit or a loss. So before I go any further, it's probably sensible to work this out, because if it's a profit he's made on disposal, it will need to be added on here under the gross profit. So let's get a working underway. So I'm on working number 4 at the moment. So the bullet point tells me the equipment sold originally cost £6,500. It had been depreciated by £4,500. So that means when he sold it, it had a net book value of £2,000. In his books, it was worth £2,000. How much did he sell it for? Well, if I look in his bank account summary, on the debit side, I can see equipment £2,100. So that must be, they haven't told me anything else, so sometimes you just have to go on what you've been given. That must be the proceeds, the amount he got on the sale of the equipment. So he had a net book value of 2,000, the proceeds were 2,100, so he's actually sold it for just slightly over the net book value by £100. So in this case, he's made a profit on disposal of £100. So it's a good job I worked this out before I went any further. It's always a good tip to work out a profit or loss on disposal as soon as you start the profit and loss section, and just in case it is a profit, because you'll want to add it in here. So let's add it in then. Profit on disposal, add the 100. So we're now at £42,710. Next, I'm going to go through his expenses. And it doesn't really matter too much what order, it's just a case of looking at the information and just trying to see what we've got. So I'm looking in his bank account, and the first thing I can see on the credit side is he has been spending money on insurance, so that might be a good place to start. So insurance then, with insurance, I can see in the table at the top, he's also given me some further information about insurance. It says other payables insurance and other receivables insurance. So this suggests or tells me that Bruno has prepayments and accruals going on with his insurance. So I need a bit of a working, and I'm going to do a quick T account for insurance. So what was going on at the start of the year? Well, that table at the top, on the 1st of May, it says other receivables, specifically insurance, £290. So if this is a receivable, this is effectively a prepayment. So he has started the year having prepaid his insurance by £290. A prepayment is an asset, so I'm going to bring that down then on the debit. There we go. What happened during the year? Well, we know from his bank account he has paid £2,500. So let's debit the insurance account because this is an expense account. There we go. And what was going on at the end of the year? Well, if I look at the table at the top, it's now switched from a receivable to a payable. And it says other payables, specifically insurance, at the end of the year, £800. So now he has an accrual at the end of the year. He owes the £800 for insurance at the end. So if he owes that, that would be brought down on the credit in his insurance account. It's a liability, it's an accrual. So if it's brought down on the credit, it must be carried down on the debit. And there it is. So total up everything. In this case, everything's ended up on the debit side. 3,590. There's nothing to take away on the credit. So in this question, the amount that relates to insurance for this year, and therefore the amount being transferred to the income statement, is 3,590. And there we go, there it is in there. Back to the bank account. So I've dealt with the insurance. It says there's been other expenses. So this must be all these other bills, perhaps wages, electricity, all these other things. They've just been grouped together. I don't remember reading anything about any other expenses. So that figure must just be fine as it is. So just put that straight in. Other expenses, £19,205. He's got equipment, but equipment is capital expenditure, so that wouldn't go in an income statement. And trade payables, that won't go in the income statement either. That will affect the purchases, but we've dealt with that. And the balance of trade payables will go in this statement of financial position. So if I just start going through the bullet points underneath, the first one, I've dealt with that, second one dealt with, third dealt with, the fourth one, he banked all of his cash sales after deducting cash drawings of 3,000. Okay, so I might need to do something with that in a minute. Equipment sold, I've dealt with that. Depreciation, well, I'll do that last. Bruno believes some cash has been stolen. Oh, right, so if some cash has been stolen, he'll need to treat this as an expense. So this might be a good one to do next. So he doesn't know for definite, but in these sorts of questions, if it gives you a hint that some cash has been stolen, it normally has been. So let's put a narrative ready. Stolen cash, then working 6. And what I'm going to do is I'm going to now use the next technique, which is to use a cash account or a bank account to help me work out missing figures. So cash account, and what basically I'm going to look through the question for anything about his cash. So in the first table, he knows that at the start of the year, he had £1,200 of cash. So that's an asset. So I'm going to bring that down then on the debit. There it is. Balance brought down 1,200. What's happened during the year? Well, in terms of cash coming into his business, I know that he had cash sales. And so that will have ended up on the debit of his cash account. And if I look back at the first bullet point again, if you remember, 80% of the sales were on credit and the remainder were cash. So 20% of his sales were cash. We already worked out the revenue on the previous slide. I've just shown a quick extract there. So we know his revenue was 85,220. So 20% of that is for cash, were cash sales. So I'm going to find 20% of 85,220, which is 17,044, and then that must be his cash sales. So you'll see I've debited that then in his cash account. Next thing, I've got any other things about cash. Oh yeah, the fourth bullet point. Bruno banked all of the cash sales after deducting cash drawings of 3,000. So there's been cash drawings of 3,000, so that would have reduced his cash. So I'm going to credit that. There we go. And it says he banked all of the cash sales after deducting the cash drawings. So if his cash sales were 17,044 and his drawings were 3,000, so basically he took £3,000 for himself and then he banked the rest of the cash sales. So that means he banked, or should have banked, £14,044. However, if you look in the bank account summary, we can see on the debit side it's got cash £13,750. And this is where we're suddenly realising that, yeah, he's right, some cash has obviously gone missing. Because I've recorded the other half then of this contra entry. So in the cash account on the credit, you'll see I've put 13,750 because that corresponds with, or is the double entry, to the debit that he's got in the bank account, 13,750. But we already know that that doesn't make sense because some cash has clearly gone missing. Then I'm going to put a narrative for the stolen cash. And what does he know at the end of the year? Well, at the end of the year, he knows he had £1,000 of cash left in the business. So that will be brought down on the debit, which means it will be carried down on the credit. There it is. So now if I add up everything on the debit side, it's going to give me 18,244. But on the credit side, that doesn't total 18,244. And that's because some cash has indeed gone missing or been stolen. So 18,244, take away what he's got on the credit side, tells me that there's £494 of cash unaccounted for. So somehow, somewhere, perhaps he's got a dishonest worker, but £494 of cash has gone missing or been stolen. So that's going to have to be an expense. I'm going to put that then into his income statement. There we go. And the final thing then, I need to go back to the depreciation. So he's got depreciation on equipment, and this is going to be working number 7. What does it tell me about this? depreciation on equipment is charged at 20% using the reducing balance method. So reducing balance is based on the net book value. It also tells me a full year's depreciation is charged in the year of acquisition and no depreciation is charged in the year of disposal. So I've got to think net book value because that's reducing balance. So his net book value of equipment at the start, he knows, I can see that in the table at the top, it was £26,000. But because he disposed of some equipment, I need to remove that because we don't want to depreciate that. He no longer owns them. And if you go back to the 5th bullet point, it said the equipment sold originally cost £6,500 and had been depreciated by £4,500. So the net book value on the equipment that was disposed of then was £2,000. So I'm going to take that out. So now that gives me a net book value of £24,000. But he also purchased some equipment. And I can see that in the bank account, the third item on the credit, he has spent £18,000 buying some new equipment. And his policy is to do a full year's depreciation in the year of acquisition. So I need to add that on then. And that gives me a total of £42,000. And he does 20%. So 42,000, 20% of 42,000, £8,400. And there is his depreciation figure. And being able to calculate depreciation or anything or rearranging depreciation or formulas for depreciation is the final technique in working with incomplete records. So now all I've got to do is total up his expenses, and that's going to give me a total of 31,689. Take that away from the 42,710. And I know then, I found out his profit for the year was or is £11,021. And there we go. I hope that's been helpful. Please do subscribe, like, share, comment, and let me know what you'd like to see in future videos.